Welcome to another webinar series from Boast.ai. Today we have a great presentation from myself on an entrepreneur's guide to fundraising. So just so everyone knows, there is a chat room where you can pop your questions in. We'll hopefully get to a Q&A session at the end of the webinar. And keep an eye out on your inbox. We will get a recording of the presentation to you within the next 24 hours. So let's jump into it, and hopefully we got some great content for you here today. So my name is Russ Armstrong. I'm the head of sales for Eastern Canada for Boast.ai. We are actually a software company that's building software to automate your R&D and shred tax claim process. So ingesting data from your technology stack to help write out a claim for you. Prior to this, which is where a lot of my content is generated from, I was the co-founder of Limelight Platform. We were an enterprise experiential marketing platform. We raised over $10 million in equity and debt over a 5-year period, and that's where a lot of my stories are coming from and the lessons I learned from that over that period. Prior to that, I spent a decade in RBC Capital Markets, which I was an institutional equity trader, trading stocks on the TSX Venture, and some international markets. So coming from a banking kind of world, that's kind of where I got the whole, thought that, what everybody talks about, fundraising for a startup. I thought it was, pretty simple. You'd join an accelerator where you'd, get. So here's in reality what it actually looked like from a mapped out perspective of fundraising over a 5-year period. And that's where I'm going to kind of spend a lot of my time today, is talking about, your fundraising journey and what it might look like over all of your different time periods, your different types of instruments you might be using, from equity to debt to convertible debentures to safes, and different government slides that you might have. Before I get into that, I just want to take a step back here and just give you a kind of overview of the fundraising landscape and what everybody's talking about in the world. The VC landscape in Canada, and pretty much it mirrors it in other countries, is growing number of deals and growing number of dollars available to people in the market. So you can see it kind of exploding higher and doubling over a 5-year period. But what also is going on during that period is the number of active startups in Canada has exploded and doubled from just over 4,000 to over 8,000 that are active startups who are all seeking funding also at the same time. So what I want to focus on more so is kind of the smaller deal size, the earlier stages of the companies where you're trying to raise money kind of in the, less than $1 million range. So about a third of the deals that were done in 2018 were under $1 million. So if you break that down into the numbers, you got 210 deals that were under $1 million in 2018. And if I break this out just based off of kind of different people's experiences raising, you're always going to have the top end of the curve where, you've got a growth rate of over 300% and you're already doing $1 million in ARR. You're probably going to have an easier time fundraising from VCs based off of your metrics. But that's not to say that the people with different metrics that aren't going to also raise. So there's that middle rack where you're going to have growth rates in the 200 to 300% range, and maybe you're approaching your $1 million ARR. And then there's the bottom half who barely get by and have to struggle. So if I revert back to kind of my experience with Limelight, I would say that we were a marketing technology startup in 2014, which was not the sexiest industry to be investing in 2014. A lot of MarTech got it off the ground in late 2000s, 2010, and by 2014 rolled around, there were a lot of people wondering what was really available or what hadn't already been done in the marketing space. So we had a lot more of a difficult journey fundraising. So based off of that, I kind of wanted to put together what I thought was a fundraising strategy around how to think about your life cycle of raising money, not just for your current rounds, but kind of an overall strategy that you're going to put together over a 5-year period to understand how you can do it. And the core piece of that is putting a valuation on your company. How do you put a value on your company? Is it a multiple of your MRR? Is it the stage and growth? What are the key drivers? Is it an MVP that you need to put together? Is it a key customer that you're signing, a large contract that's about to come in? How do these drivers affect the valuation of your company? And then obviously talking about those milestones and how those milestones affect the valuation of your company. So those are key in determining how you'll be communicating with your investors, with your VCs, with your internal teams. All of these are important to the impact of how your company is going to grow and your raising life cycle. And obviously you have your options because of the uncertainties that are going on, where you might need to adjust your milestones to match your cash on hand, or your alternative is obviously raise additional cash to hit those milestones. So keeping those all in mind, how do you go about going to market? Because obviously the key here is to avoid your cash out or your out of money date before you hit that next milestone where you're able to raise more money. So this is your what you're looking to avoid at all costs. So just want to touch on valuations a little bit and what I kind of came across from my experiences. The majority of the time we're looking at subscription based, so you're going to see a rule of thumb where you're going to see 6 to 9 times multiple on your monthly recurring revenue. And sometimes they'll do a trailing 3 months or a forward-looking 3 months, but it's usually in that 6 to 9 times range. And depending on your luck, you might see it. So some of the factors that will change your multiple from the 6 to 9 times could be your total addressable market that you're going after. That could be from your top-down analysis, bottom-up analysis. Could be your team. I can say from experience now going through it as a first-time founder, there were a lot of uncertainties of going to market and how to scale it. Going through it again, it might change a multiple that you'd be able to command when you go out to market. Your timing. This is an interesting one that I think is something that a lot of people miss, and it's the why now question. Why is now the right time for this industry to be disrupted? And it could have to do with your KPIs and who your buyers are and how savvy they are and what their tech stack looks like. There's multiple things, but addressing the timing of why now it's the right time and what trends are happening is very important when you're trying to command a premium multiple that you'll be getting. A quick example of that I'll just jump into real quickly. For what we were selling in marketing technology, we were selling into the events team. And I remember our solution allowed you to calculate an ROI and attribution for your live experiences. And I remember presenting to a large group of 20 people, and I was talking to the room and saying, hey, you'd be able to calculate an ROI for your exact events. And one of the participants in the room looked at me and said that that's really great and everything, but my KPIs are how many people show up. And I didn't really know how to react. And it was an interesting kind of statement for them to make, because I was kind of offering them the future of being able to actually track and measure things. And they were still using KPIs that they were bonused on and paid on. That was something that was very basic. So again, coming back to this timing thing is very important to it. Obviously, sector is another thing. So as I said, in 2014, MarTech sector was not the hottest sector out there, but as you can imagine, for those who are raising money in blockchain, AI, or cryptocurrency, you're probably going to receive a higher multiple at the current time. And then obviously your growth rate on top of your monthly recurring revenue. Is it growing at a fast clip? Are you going 300% a month? Is it slower than that? And this is an interesting factor that you need to take into consideration when you're actually planning it out. At your early stages, you might think about if you just landed a contract, when you got to 50 MRR and you go out to market, but if you've got nothing behind that and you're fundraising over a 4 to 6 month period, and you're not showing any growth while you're fundraising out in market, that's going to look very bad. So planning out and understanding what your pipeline is going to look like and what your revenue growth is going to look like is all part of the plan when you're building out your strategy of going to market. And obviously some of those logos, what is your social proof, your social validation? Have you landed large conglomerate companies? If you're an enterprise, do you have numerous logos? Have you cornered a certain niche of the market? Those logos are very important also for the multiple that you're going to command. I think your key thing to consider here is your valuation is not going to be linear. You're going to have ups and downs based off of interest that could be from, collecting different term sheets, investors getting investors, term sheets getting term sheets, all of those things. So these are all items that impact your valuation and understanding what that's going to look like when you're trying to raise. So from a fundraising process, I just wanted to kind of give a rundown of kind of some of the things that I did to help me fundraise. And I'll go into the details a little bit further when we get into the actual life cycle. But I guess from a key consideration is you're going to have lots of investors in your funnel. 100 plus investors in your funnel is something to think about. And to do that effectively and actually communicate on a one-on-one basis, you're going to have to set up some automation. There's lots of sales tools that have template-based add-ons to your email where you can actually just pop up templates and send it out, but you're going to have to set up some automation to help you do it. Always be prospecting is an interesting thing. Even if you have those investor meetings, ask those VCs for other intros because they might know people who are interested in your space. They've talked about theses that they might have in that sector, and they might be able to put you in front of someone who is interested in investing in what you're working on. There also might be times where your VCs might not have the capacity to work on what you're doing. Again, I like to look at this working backwards from your metrics. What's your metrics need to look like at Series A, at a seed round, at a convertible debenture round? What do your metrics need to look like for venture debt? Working backwards from those to kind of give you a guideline of what those milestones are you need to hit will help you plan out your strategy a little bit more. Obviously, having that FOMO story, the fear of missing out story, is key. When you're building out your strategy, every deck in your story, every communication that you have is kind of the inevitability of the success of your company, and making sure that you're consistent across those. I do like to talk about term sheets, getting term sheets. Early in this process, you might get term sheets that are not necessarily the most optimal ones. They might have different terms in them. They might have board control that you're not willing to give up at an early stage. But term sheets do get term sheets, and there are lockup periods. But if you're in an ongoing negotiation with multiple parties, you do have a small window where you can try and twist people's arms to get them to, move a little quicker because they might miss that story or that FOMO of missing out on a good deal that's coming their way. I think the majority of things that you really have to think about is having a plan B and understanding that if things do fall through, what are you going to fall back on? Obviously, if you're going out to market with only 1 month to raise cash to keep your company floating, you're probably going to need a little more time than that. So always having a plan B, and that could be from a debt provider, a shred financing, and we'll get into some of those things, but always having plan B in case things don't work out accordingly. So a couple tips to help you with this, and just think about it as a pure sales funnel. Obviously, if you're going out to 100 VCs, you might get 20 replies and 5 decisions, those decisions might be actual in-person presentations, and maybe it's 1 term sheet from 100. But based off of that, continue to ask those people who are responding for other intros to help keep more people in your funnel to keep it going. You're obviously going to have to keep records, and obviously a CRM would help, but a G sheet I think is just good enough where you can actually update it and keep records of comments they've made or sectors they're interested in, thesis that they might have. Which also brings me to the point where you might want to talk about asking your VCs the right questions. And I think that's something that is often missed out on, is understanding what VCs' motivations are, what life cycle their funds are at, what theses they have around what they're investing in right now. All these things are very relevant questions to helping you get to the right answer and making sure you don't have a kind of false positive thought about where a process is going. Interesting on the VC life cycle, take for example a $100 million fund. If they've invested $50 million in new companies and they're holding back $50 million for follow-on investments, they're probably not going to be very active with new investments currently because they're kind of tapped out. So just understanding where their life cycle is. If they are a brand new fund that hasn't made an investment yet, they are more likely to invest in those early stages. And again, they probably only have a limited capacity of the number of deals they can even look at a given time. If they're a smaller team of 3 or 4 and they've already got 3 in due diligence, then chances are they're not going to be able to take anything else on, which is going to push back or delay or potentially just be a no based on timing. So interesting things there. And then understanding if they like to lead rounds, if they like to follow on rounds. These are all things that you need to understand from your VCs when you're going out to market. So at this point, I figured I could walk through kind of a life cycle and some of the thought processes around when we were raising and trying to understand how to get to market and grow our company in the most effective way. So early on, what we did is we did some common priced rounds where we actually raised at a multiple, and we were just doing a common equity. We decided to pursue an accelerator route in San Francisco. We joined the Acceleprise group. They have offices in New York, Washington, and San Francisco. We decided to do that to get some proof of concept and understand that, get some guidance from the best minds in the world about growing our company as fast as possible. One of the other great things from this was introductions that they could make to angels groups, and some early stage VCs that might have some interest to follow on down the road. These were key to our early fundraising strategy, and probably would not have allowed us to have the success we have if we weren't those introductions weren't made from those early stage companies. So a couple things I kind of take away from my early stages was cleaning up your cap table. So really understanding, and I used to get a lot of VCs who would talk about this, but not really dictate what that actually meant for you as a company and what you needed to do to fix and rectify those issues. So obviously you want your cap table to reflect those in the company that are going to carry your company into the future. So, they could be through founder shares where there might be restrictions on vesting. There could be, ESOPs. It could be other different options that you put in place, but making sure the people who are going to take the company into the future are reflected on the cap table accordingly. If you do have issues with that, there are options to issue additional shares or new classes of shares to rectify that issue that's going to take you further. And obviously your second thing before you go to market in your early stages is you're going to have your IP in order. The last thing you're going to want to have is someone claiming that they have IP on your company because it wasn't locked down and ironclad when contracts that were in place. Think about Facebook and billion-dollar settlements down the road. I guess that's not all bad if you're worth that much, but definitely better to avoid it in the first place. So second, after we graduated from the accelerator, we decided to go out and raise additional money in the form of a convertible debenture. A convertible debenture, as I'm sure a lot of you would know, is a debt instrument that's pretty much considered as equity that converts to equity upon a qualified transaction in the future. And we raised it at two different cap levels, a $5 million cap level and an $8 million cap level. You can see that our multiples were kind of in the middle of that range that I was talking about earlier, in about the 7.5 to 8 range. And some of the interesting things we did at this point was that we offered it on I'll just go back one slide. We offered it on a capped basis. So we tied our MRR to the cap that we were offering. So at a 55 MRR, we were offering at a 5 cap. And then as we grew to an 85,000 MRR, we changed it to an 8 cap. This was communicated as part of our strategy that we're going to raise 250 on each. So when we went out to our investors, they knew what the table stakes were, and if we hit certain milestones, what that meant for our valuation. It created some FOMO that allowed us to have a little bit of leverage to create some urgency on the investor side to help them write a check a little bit quicker. An interesting thing you'll note is on our second round, we were actually converting it into preferred shares. This is when we got our first institutional investor. We landed an investor that had a fund in the Midwest. They were pretty much gave us a check to have a placeholder on an option for future rounds. Now, while they were not super active on providing introductions to potential clients, they did help close out that round with some introductions to some angels and some other early stage seed investors that were around, which helped us get through that round. And this is just covering off kind of a strategy that you can go to market with where you link your MRR to a convert cap. This is something that you need to be pretty transparent about at the get-go. But again, it allows you to be a little more transparent and allows you to have a little more urgency on what you're doing. I'd say the rule of thumb that most people go by is if you're raising less than $1 million, use converts or safes. And if you're raising more than $1 million, do a priced round with equity. I think that's a safe rule of thumb that everybody can work with. All right, so what did we do next after that? We did a SR&ED financing round. For those of you who are familiar with SR&ED, I'll just give a quick little summary there. It's a program in Canada where over $4 billion was returned to 27,000 companies for qualified work, and it's up to 64% of salaries. If you were in the US, there is a R&D tax credit program where you'll get 10% back, and there are financing options for those as well if you're of substantial size. So just to give you an idea of some of the terms that are available, there's a lot of companies out there that provide SR&ED financing, but finding the right partner is critical. As you might see interest rates that are 20 to 30%. Finding the right partner, you should be able to find something in the 9 to 15% range. It is an operating line, and they will do claims as small as $50,000 on a refund, and they will do 75% advancement rates. So that would be as you incur the expenses throughout the year, they will actually give you a 75% return rate on it. You can do 1 to 2 week turnarounds on these, but I think the key to understanding this is you need to have your claims done by a reputable firm. Your SR&ED financiers will work closely with the consultants to make sure that they are trusted and that they feel that there's a strong probability that they will be getting the money back. So being prepared by a reputable firm is key to being able to capture interest rates as low as 9 to 15%. Interest is capitalized and paid upon the refund being returned to the company. So after SR&ED financing, to keep the ball rolling with the company, we did a preferred round, and it was a seed equity preferred round where our multiple continued to kind of stay in line around that 8 mark. Really depended on the growth and the time, and the amount of interest that you got from different investors. I would note that during this process, there were other term sheets that were being worked on the side from multiple players, and then picking the best one that was obviously part of the strategy of kind of leveraging it to get the best deal you possibly could. Obviously, when you go through an equity round, when you're pricing a seed round, it is a lot more time consuming, a lot more legal costs and expenses involved with it. Obviously, you're giving up board seats, and that's something you'll have to negotiate with your investors about, how many board seats they will be getting. It is a lengthy due diligence process where you'll have to have a data room set up with all the information to talk about. And there are market terms out there, which is what I would strive for. I would say hire a good lawyer straight out of the gate to fight for you to get market terms and understand what those are. It becomes a lot easier down the road if you have new investors coming in, if there's no wonky terms in your deal. So making sure that you have an experienced lawyer who knows what that means and fighting for that is key for your success in the future. One of the things I didn't highlight before about the convertible debentures, which I think is quite interesting and unique on it, is that the money is received as you close investors. You don't need to close an entire round to get access to the capital. With a convertible debenture, as you close an investor, they will send you the money and close on that convertible debenture. Versus an equity, the money will be held in trust until the round closes, where at that time it will be released to you. So just a different timing on when that money is coming. So this is talking a little bit about Plan B at this point. As you can see on the right, the MRR started to kind of taper off a little bit. Weren't seeing the same type of growth that we would have seen in the past, and it was stalling out over a little bit of time. A lot of this was due to enterprise sales and how slow it was taking for it. So at this point, you have your burn that's still continuing to go. And we had to look at options. We had a significant pipeline that we were working on where the future looked bright, but the delays in closing deals was causing us to burn and, burn a little too close to where we wanted to. So there was kind of the option at this point of looking at venture debt or doing a seed bridge or seed 2 round, as some people call it. And that was kind of what we were looking at this point. So sometimes you'll see this on venture debt and on some seed rounds as warrants. For those that aren't familiar, warrants are pretty much long-term options that allow the holder to buy the stock at a discounted price in the future. They are options, so they have the option to exercise it in the future or not. And you'll see this as a sweetener on deal to help get something over the line. And then obviously you also have options that you'll start to get into when you do seed rounds, where you're going to have generally 15% of your fully diluted float set aside for an ESOP. All right. At this point, I'm going to talk a little bit about venture debt and some of the government debt options available out there, the different types of debt that are available, and how they're around. So obviously, non-dilutive financing benefits are, it's a great option to have if you have the right metrics to capture it. You're not giving up any equity, no board seats, there's no personal guarantees on them. And there's a number of reasons why you would want to execute on these. Obviously, one of them would be to extend your runway before an equity round, where you could get your multiple up and change your valuation, which allows you to sell less of your company or command a higher premium or valuation at that time. Another way to do this, which is an interesting one, is if you are about to land a contract and you know it's stalled but think it should close, looking at some debt options to extend your runway. Obviously, if you're doing enterprise and you add another 40, 50 MRR to your recurring rate, there's going to be a big difference on your valuation if you're going to market to raise. So these are some of the reasons you might see it. So here are some of the non-dilutive financing options that are out there. So secured debt, which is bank debt, which we'll touch on first. Then we'll go into some venture debt options and what the metrics are and what they look like on those. And obviously followed by revenue financing or contract financing. We'll show you some examples of how that works. Shred financing, which we already covered. We won't jump back into that a bit again. And then there's obviously some government debt options plus some other government grants that are available out there. So first, we're going to start off with our secured debt. These are bank debts, and it's usually at a prime plus type interest rate. Typically, you'll see these in the 5 to 9% range. Minimum qualifying is usually around 100K in MRR, where you'll get a 4 to 7 times multiple as a line of credit, which would mean that $400,000 to $700,000 line of credit that you'll get. These are first in line and secured by the IP of the company, so you'll have to sign a security agreement, a general security agreement. Generally, these are 2 to 4 week turnaround times, and I take that a little bit liberally. I always recommend for your CFO or whoever is running it is to start your relationships with these providers early. 2 to 4 week turnaround is for an existing relationship, from my experience, not from a brand new relationship. So if you are already having a relationship with somebody, it will definitely help you speed along your process in the future. Obviously, red flags that a lot of the banks and debt providers are looking for. They prefer B2B business. So if you're too much on the B2C side, they are not going to like it. If your client concentration is all bundled into one client, that is another red flag. Seeing gross margins that are below 65% or churn that's above 15% are all things that are red flags. One of the things that is a green flag, obviously, is to have a institutional investor who is on your cap table. Generally, this is because they look to have, because they're first in line and debt ranks above equity in your liquidity stack, that if there's an institutional investor there, they would potentially do a down round or continue to fund the company beyond letting it go into bankruptcy and solvency and distributing the IP around. So that is a reason why they like institutional capital. Venture debt, which is pretty much like your secured debt, but offered by kind of your boutique providers. You have an operating line where they'll usually force a minimum withdrawal, so you'll start incurring that interest rate away. Interest rates are between 13 and 20%, plus warrants sometimes. Again, this is all negotiable. Rule of thumb for going out to market is get 3 quotes. I've often seen times where venture debt providers will fight against each other, and it might be your 3rd round before you get the best offer and the term sheet from them. Similar numbers. I have seen some below MRR, 100 MRR, if you have an extraordinary high growth rate. I have seen people get venture debt from the 50 to 75 MRR range if you have a growth rate that works with it. Again, this is secured by the IP, but they will be second or third in line on the liquidity preference. Revenue financing is a different way of approaching it, where you can finance off the revenue that you have, your MRR that you currently have, where it's just a different way of structuring it, or contract financing is another way of looking at this. So the royalties could be anywhere from 0.5% up to 4% of your revenue, and they will give you, say, $1 million. Your buyout would be to repay the principal plus a one-time buyout fee, and then any of the royalties that you pay during that period. The revenue financing positives are that it is completely up to the entrepreneur when they want to pull the trigger and pay it out, or they can let it run indefinitely in the future. Obviously, the higher your revenue goes, the more that percentage of that revenue is going to cost you in your monthly payments. But a different way of looking at it, and you can crunch your numbers on to see if it makes sense for you or not. Here's a quick comparable table where you look at kind of the different ways of raising money, different costs of capital across. So from a venture capital perspective, because they are early stages, your cost of capital generally is between 40 and 80%, as they are buying a significant percentage of your company that's going to appreciate significantly in the future. Private equity, they're looking for a little less on a return standpoint, but they are definitely looking for 51% control on the private equity side. Revenue financing around the 15 to 25% is your cost of capital with a 3 times payback. And then you'll see venture debt is similar to that at the 15 to 25%, and then senior debt or secured debt from the banks at 4 to 8%. Some government debt options that should definitely be on your radar. The FedDev Ontario Fund, which is a $1 billion fund that was just re-upped to be distributed over the next 6 years, has been very active. The money goes sporadically, and they will, you have to get in the queue at an early pace to be able to qualify for it. There's also a program called SOFI, which does up to $500,000 loans for early stage companies. And this was actually the first debt that was on my books, was a SOFI loan. Other government grants is available. You can come to the boast.ai website, and we have a comprehensive list of grants that are available. You should definitely check that out. But some of the more popular ones, as we mentioned, was SR&ED, where you can get up to 63% of Canadian R&D spend back as cash, or your IRAP, which is another one that will help fund your project costs up to 50 to 80% of that. So who am I going to call based off of the debt providers that are out there? Here's a quick chart to give you some ideas of who you can go out to call. From a venture debt perspective, there is Espresso and Firepower Capital. Espresso has kind of been the market leader in venture debt. I think they did over 65 deals last year. From a revenue financing, capital financing, you have Tamaya Capital and Flow Capital. From mezzanine and venture debt also, you have BDC, Silicon Valley Bank, and Comerica. SR&ED financing, there's a couple providers that have great rates that you could talk to, Venbridge and Easily. And then on the senior debt side, you have the banks that are active in the early stage companies. Roynat Capital is the arm of Scotiabank, the RBC, KBI Group, which I was a client of in the past, CIBC Innovation Banking, which is quite active in the space, and BMO. Interesting thing is to make sure you're talking to the EDC if you're doing any exports into the US market. They do have loan guarantee programs that I think you should be aware of. You have to bring them to the table with some of the senior debt providers, but they will actually guarantee the loan, whereas the actual financing comes from one of the senior debt providers, which allows you to qualify for senior debt rates that you wouldn't otherwise be qualified for. Finally, we did what I'd like to call a Canadian A, where we raised about $4.7 million. Generally, you might see this as a as a seed round in today's market, but we couldn't call it a seed 3, so or a seed bridge 2. So we called it an A at this time. So you can see the multiple depressed a little bit based off of the growth profile, but it was also preferred shares that we issued. I'm not going to spend a lot of time on this, as there's tons of opportunity to do future webinars on some of these topics. But I did want to kind of wrap it up at that point. Just to revisit on SR&ED and what BOS does. We're the only SR&ED automation software available with over 300 clients across North America. We have offices in San Fran, Calgary, Toronto, and Vancouver. And at this point, I'd like to kind of open it up to Q&A if anybody has any questions out there.